You got something none of us have.
Oh, come on. Why is it always this? I mean, I fucking owe it to myself to do this or that. What if I don't want to?
No. Fuck you. You don't owe it to yourself. You owe it to me. Because tomorrow I'm going to wake up and I'll be 50. And I'll still be doing this shit. That's all right. That's fine. I mean, you're sitting on a winning lottery ticket. You're too much of a pussy to cash it in. And that's bullshit. Because I'd do fucking anything to have what you got.
And I know a lot of you guys are questioning all the time, why don't I ever talk about Dow? I don't trade the Dow. Okay, I don't trade it, but I do incorporate it with my analysis between the three averages. So on big down days or large range days, big ranges beget small ranges and small ranges beget large ranges. I learned that from Larry Williams, and I think it's a truism. It's going to never fall out of style. It's real. When there's a lot of excitement, when there's interest in a market, that's when everybody else feels comfortable going in. As soon as you determine, if you haven't really got that much experience yet in trading, the sooner you can find out that you're in a day like that, better. And then you're met with, do I continuously watch the market, or do I wait to the last hour of trading? And that's kind of like the takeaway from yesterday. You're going to learn by failure that you're not going to see these things coming all the time. But as a precursor, just know ahead of time, when we have big down days and there's a large range day and we're near the end of a daily range and we're within the last few trading sessions, and now, for weeks and a month or so, we've been bearish. We've been seeing the indices go lower since the beginning of April. So if you're going to be day trading or studying price intraday, you have to be aware of what may transpire after you see these big down days, especially if you see a outside day with a down close near the end of the price run. And what do I mean by the end of the price run? If you refer back to the low made on May 12th versus the April highs on your daily chart, that whole entire price swing, we're near the end of it right now this week, but we didn't get a lower low on Thursday with NAS or SPOOs. We got it with Dow. So while I don't trade the Dow, and why don't I trade it? To me, I think it's a little too sloppy. It's erratic. And I'd prefer to be in S&P. S&P will have the cleaner price moves. NASDAQ, if I'm in an idea that is parabolic, in other words, I think the market's really going to run, I think it's going to really take off and have a big range day, I want to try to trade in the NASDAQ because I want that, because it tends to exaggerate everything when it's a big move. Other people may say, well, I'm not going to trade the NASDAQ because it's going to rip my face off and I'll slow down and go into the S&P. I'm not like that. I'm not afraid of that. You won't be afraid of it either, but it doesn't mean it's an invitation for you to go out there and risk a lot of money. And everything I teach you should be viewed in the context of paper trading and demo. But I've kind of like wanted to go into this year, like I mentioned last year, of trying to prove to everyone that there's no reason for you not to go in and look at this stuff on your own and see it for yourself. But invariably, when you do these things, like Murphy's Law, whatever can go wrong will. And as a new student, it's very easily found for a new student to be discouraged because of initial adversities. And if you started, like, for instance, if say you signed up for this whole business of ICT mentorship, ICT concepts, smart money concepts, whatever, and you started learning yesterday, that is going to be a huge hurdle, and it's going to create a lot of doubt and confusion because the intraday range was choppy, it was sideways. The whole context was stay out of the marketplace because we went to 50-50. So 50-50 means we're going to be in consolidation. Consolidation means wait till the last hour of trading. It doesn't mean you're going to get it right. It doesn't mean I'm going to get it right. It just means that as soon as you realize you're in a choppy, range-bound market, especially with index futures, this is predominantly linked to just index trading. A lot of traders just want me to, or students, I should say, want me to just get to the point, give me a way to buy or sell pick my entry, give me a way to determine where my stop loss should be, tell me how to move my stop, when should I move my stop, and give me a target. And without expecting that to be understood, because I've already done all of that. Like, that's already on YouTube right now. The problem is there's so many variables to how the market's going to book, present. What I mean by present, it gives you opportunity, and sometimes it gives you these impressions that it may be a good day to trade, but then all of a sudden, as soon as you press the button, it does what it did yesterday. And it can be very frustrating. I can tell you, as a younger man in my 20s, when I first started trading the S&P, we didn't have these big ranges back then in the 90s. They were nowhere near the level of volatility that's available to all of us now. But the idea of getting in on those days like yesterday, when I was a young man, I would be in there trying to capture every continuation, bull flag, bear flag, the whole business. I would go after everything I possibly to anticipate the next run, but only on the upside, because I was a buyer. I didn't want to short anything. But I would literally blow my accounts out all the time with those types of days. So you have to know what leads to those events, so that way you can avoid it, or at least know that once you're in it and you've taken a loss or two, you have to learn how to stop. Like, you have to stop and not do any more trading. And when it's easy and the markets are real primed, when it's easy to see the market drawing to a particular high or a particular low, and it's one-sided, that's what I teach as a low resistance liquidity run. Okay, where you have just a real easy run to an objective. It's so one-sided, you can't even argue about the possibility of an opposite perspective. That is my definition of high probability. I get the question all the time, like, what makes a trade high probability? The fact that you can only really define it either in a bullish stance or a bearish stance. And using the concepts that I teach, it is impossible to sell it to yourself as a opposing opportunity. In other words, if you're bullish, if you think the market's going to go up, can you go in any way, shape, or form, justify a short using what I'm teaching you? And if that's true, you can find something that's short. That's not high. It doesn't mean that it can't still go up. It just means that it's not high probability. So when I'm mentoring my students, I'm teaching them to look for those types of setups. When I give you these lectures and I talk about, the things that are going to be problematic, they're conversations that the young guys want. Like, you don't want that. You want to be in these big moves that capture a lot of movement, make money, and then parade on social media. That's not what I'm trying to inspire. I'm trying to inspire folks that have a sober mindset about the real risks involved in this industry, because it's easy to hurt yourself. As I mentor, as I teach, as I try to bring things to light with, the things that I use and implement in the marketplace, there's this large chasm, okay, between hearing me or watching me display an idea conceptually versus really understanding what it is that is required to do it yourself. Because the analogy I use all the time, it's not like you watch the video and it's an instant download. It may feel like that. It may look like it's easy. It's not easy. It's not easy. When you're developing and you're learning, it's normal for you to have that overwhelming sense of uncertainty. That's a normal thing. And I had that for a long time. Nobody was really cheering me on. I'm telling you that that's a normal part of this process. I want all of you, at least in my target audience, is I want everyone to appreciate the underlying risks, because it's real easy to wreck yourself financially, emotionally, psychologically, and it's painful. And you can develop real mental illness from allowing yourself to be harmed in these marketplaces, because it's easy to just feel like, okay, well, I got time, I'm going to sit down in front of the charts. And if you applied that type of mindset yesterday, if you are not versed in understanding what you're doing in the market, number one, two, with what I'm teaching you, and you say, I'm not going to look at the market because the setup's not there, you're cheating yourself from real experience that's going to protect you in the future. I'm not always going to be here to point to where the market's going to go. I'm not going to be chit-chatting with my mentorship group, in the future when I can't do it. They're going to be left to make these decisions and lean on their own experience. So when I teach, I'm teaching an independent thinker's approach where you're not handheld with me. I'm not trying to glad hand with anybody. I'm not holding anybody hostage. My intent is for you to be able to look at the things I'm teaching you, go through the experiences and endure the things that are required for you to get a better understanding of what it is that's required to participate in these markets. But the importance is you have to go through these long periods of boring price action and looking at things that aren't necessarily going to put anything in your pocket immediately. So when you're just observing and you're tape reading, not even demo trading, all of you should still be in the observation and maybe just starting to work into forward testing. But forward testing is not pressing a demo. Like, you got to be sitting down in front of the market and tape read. Make annotations on your chart without pushing a button. Stop thinking about how much money you're making or losing, and stop thinking about all the opportunities that you're missing. Things repeat. That's some of the better takeaways from sitting down in front of the charts and reading price on a day-by-day basis, because then you'll be convinced rather quickly that there's an ample amount of opportunities over the month. Stop thinking that you have to trade every single day. If you beat yourself up and not know what you're doing and you overtrade and or push, when I'm looking at the market, I'm not looking for these little tiny micro moves, okay? I'm looking for a move that could be framed as a small scalp like that, but I want to be part of a larger price run. I mentioned earlier in the conversation that I'm teaching my students to look for low resistance liquidity runs. That's either going long and running above an old high, or going short, target of running out an old low. That is kind of like my bread and butter approach to trading. There are things that obviously help me frame that logic and that idea. Low resistance liquidity run. The idea of looking for trades that are one-sided, where it's easy. You don't have to put a whole lot of thought into it, but waiting for those types of setups. Those are, in my opinion, what traders should be striving to trade and hunt, not looking for just any old pattern. You're all learning my fair value gap. Not every little gap constitutes a low resistance liquidity run entry. Many times it could be just filling it in. It's because it's a common gap. Fair value gaps are part of a underlying logic, and it's not just a small little separation that's highlighted with 3 candles.
Wow, what you just learned here could change the whole approach to trading. Are you ready to take the next step? Your next big insight is just one click away.